Hello everyone, welcome back to Gold Predict, and today I'm going to show you the only chart you need to see to support a recession in the next, 3 to 6 months. That's my guess anyway. So what we're looking at here is the ratio of economic leading indicators to coincident indicators. Leading economic indicators have been down for roughly 15 months straight, but the coincident indicators ticked higher recently. But what we want to focus on here is the divergence between these two. When you have a wide divergence, this almost always precedes a recession. Will this time be different? I don't think so. Currently, we're down almost negative 10 points between the two, which is, the last time we were at this level was right before the great financial crisis. Prior to that, the 2000 dot-com bubble, and prior to that, the 1990 recession, and then we had back-to-back recessions in the early 80s. We got down here, and we had a recession, bounced, and then we had another recession. And you can't quite see it, but back here in 1974, we were down to this level again. And the 1974 recession, the stock market declined 50%. Let's see here. In the 2000, we had another 50% decline. And during the great financial crisis, the stock market declined 57%. The other recessions were a bit more minor, and they only corrected between 22 to 27%. So here we are again. Is this time different? I don't think so. Everybody's calling for a soft landing or a no landing, and I think that sets us up for a hard landing here, maybe in the back half of this year, but definitely I think in the first half of 2024 we're going to be headed into a much deeper recession than most people think. Okay, so what does all this mean for markets? So I don't know if you're familiar with this gentleman. His name's Milton Berg from NB Advisors, but he does turning point analysis, and he has been spot on. Back here in September and October, he had multiple signals supporting a low, and back at that time, he gave a target for 4,650. We hit 4,607, so that's pretty darn close. Now he is calling for a potential top. 4 days after the rebound high here, we had a down gap, and that gave him a signal, and he's assigning 78% odds to a potential topping process right here. At a minimum, he sees between a 5 to 8% correction, but if prices break lower and we head into a true bear market like the previous chart I showed you supports, he thinks that we could go and break the October lows. So in a normal bear market, a minimum, we need a 20% correction, and that would put us around 36.86. So let me draw a line on here for you. So 36.86. So roughly right around here. That would be pretty bad. But if we go into a deeper bear market, the 74 bear market, the 2000 bear market, and the great financial crisis all saw 50% corrections. That would put us around 2,300. That'd be awful. I don't foresee anything that deep, but I think we could at least revisit the October lows and potentially break below them before this bear market finally resets. We'll see. Time will tell, but I'm watching this gap here. As long as this gap stays unfilled, I think the stock market may be rolling over into a top and into a secondary decline, which could lead into a bear market, definitely into 2024. All right, so what does this mean for gold? Well, I called the 4-month low here in late June, but the rally out of this cycle low has not been impressive, and it's mostly because we've had a sharp rise in long-term Treasury yields. So here in the bottom panel, this is the 10-year U.S. Treasury, and I think it bottomed around here, around 3.75, and it's been rising. It's almost exceeded the highs from last October, and it looks like as bond markets reset, we could break out to new highs, and this is going to be a headwind for gold. I think the 10-year Treasury and perhaps even the 30-year Treasury could head towards 5%. Currently, they're at 4%. So the last time this happened was around this time last year. So in August of last year, we saw the yields on the 10-year note rise from 2.6% to 4% in that short time, and that during that corresponded with a $200 decline in gold. So I don't think we're going to rise, 1.4% over the next 2 months, but we could go up another percent from here. And what that could mean is gold may come back down here to around the $1,830 level, and that would finish an ABC measured move to complete what I think is probably going to be a wave 2. I don't have the Elliott wave count on here, but we have a wave 1, 2, 3, 4, 5. And then we have an ABC that would complete wave 2, and then we'd be on the upswing for the beginning of a strong wave 3, which will take us to new all-time highs. I was hoping that gold was going to break out above this $2,085 level in August. That doesn't look like it's going to happen now. So at a minimum, I think prices will probably chop sideways, and they may retest the $1,900 level. But if the 10-year note breaks out and it goes to 5%, then that could be the catalyst that takes gold down to around, I'm not sure, 1820, 1830, maybe even as low as 1800, depending on how violent the move in Treasury yields is. All right, and lastly, let's try to figure out what this might mean for gold miners. I like to use GDX as my gold mining proxy, and it looks like prices could come back to around the $26 level, provided they break the June lows decisively here. So we had a cycle low. This was like the 4-month cycle low. The rally faded quickly as interest rates increased, and we're trying to find support right now around this bottom, around 28.90, 28.60. I'm not sure if this is just going to be a bounce and then prices are going to roll over and come back down. Again, it all depends on what interest rates do. But if gold continues to fall and it breaks the June lows and heads down towards 1850 to 1830 to 1820, then I think we will complete what I believe to be an ABC correction to finish the wave 2. So in Elliott wave terms, it's a little bit clearer here. So we had a wave 1, then we had a wave 2 pullback, then we had a wave 3, and then we had a wave 4 pullback, and then we had a wave 5. And now this looks like we have an ABC down to complete the A wave, and then we have an ABC up to complete the B wave, and then we should have another probably 3 to 5 wave correction down towards, I'm finding support around $26, which also corresponds with the prior wave 4 low. So that's where prices should find support, provided we do break these levels. I'm not sure if we will, but if that's going to happen, it's going to happen within the next 2 weeks, in my opinion. Prices are already somewhat oversold here, so we're going to see a bounce, but I don't have a good feeling about this cycle. In a normal, healthy, bullish, right translated cycle, prices should not be back down here testing the prior cycle low. So this looks like we're going to have a failed cycle, and I think we're going to find support around between 25.50 and 26.50. And the good news is that should complete the larger wave 2, and then from here we should begin a strong wave 3 up. Wave 3s are the strongest, and that should take us above the May highs. So I remain very bullish on gold miners. I think they're incredibly undervalued, and we could have another opportunity to load up here if we break these June lows. So that's it for now. Hey, if you like precious metals and you like macroeconomic technical analysis, those types of things, come check us out at Gold Predict. This is what we do. I post 3 updates a week. I have a educational portfolio. It's fairly priced, in my opinion, $400 a year for a premium subscription, which gets you all kinds of different things. So if you like it, thanks. Subscribe, hit the buttons, do whatever kids are doing these days. All right, thanks. God bless you. Bye-bye.